Welcome to The Explainer. Today, we're going to demystify exactly how your final tax bill is actually calculated. It's kind of like a giant puzzle, right? To figure this out, we're going to follow the contrasting journeys of two very different taxpayers from our source material. Courtney, an architect with a pretty complex financial life, and her mother, Graham, who's enjoying a much simpler retirement. So let's dive right into this universally relatable question. You spend hours, sometimes days, figuring out your taxable income, but what does that number actually mean for your wallet? Today, we're tracing the exact path from that abstract taxable income number all the way down to the literal dollar amount you ultimately owe the IRS. To do this, we'll follow the formula for calculating your net tax due step by step. We'll look at the regular tax computation, the AMT alternative, FICA and self-employment taxes, the sheer power of tax credits, and finally, prepayments and penalties. Okay, Section 1, regular tax computation. This builds the baseline of your tax liability using standard progressive tax brackets, because getting to your taxable income is really just the beginning. Applying the right tax rate is where things get real. The contrast between our two taxpayers here is just stark. Think about Graham. She's got a super simple retirement income of just $1,040. That falls straight into the lowest tax bracket, meaning she owes a tiny base tax of just $104. Pretty straightforward, right? But then we have Courtney. She has this complex, layered income of over $165,000 coming from her salary, some side consulting work, and dividends. Because the U.S. uses a progressive tax system, portions of her income are pushed into higher and higher tax brackets, capping out at the 24% marginal bracket. That leaves her with a base tax of over $30,000. Now, this next part exposes the highly controversial marriage penalty or benefit, depending on how you look at it. Take scenario 1, for example. We have a couple with two high-earning wage earners making a combined $800,000. If they file jointly, they actually pay about $1,300 more than they would if they were just two single individuals filing separately. Literally a penalty for being married. But look at scenario 2. A single breadwinner household making that exact same $800,000. Filing jointly gives them a massive tax benefit, saving them over $32,000. Same exact household income, wildly different tax bills. We also have to navigate a few exceptions to these basic rules. Take the kiddie tax, for instance. You see, parents used to shift their income-producing assets over to their kids just to take advantage of the child's much lower tax brackets, while the kiddie tax stops that right in its tracks. If a child has unearned income, like dividends or interest, that exceeds $2,600, that excess amount is taxed at the parent's higher marginal rate. So if Courtney's son Duran gets thousands in bond interest, the IRS is going to tax most of it at Courtney's 24% rate, absolutely not Duran's lower rate. Moving right along to Section 2, the AMT alternative. This is a potential trap for high earners, implemented decades ago to make sure folks who take advantage of massive deductions still pay their fair share. Okay, let's dive into this incredibly intimidating IRS Form 6251. This is what grounds the theory of the alternative minimum tax in reality. Basically, this form forces taxpayers to take certain deductions they used on their regular taxes, things like state and local taxes, and add them back in. It effectively creates an entirely separate, much broader tax base. So the absolutely crucial point to remember here is that the AMT is an alternative. You calculate your regular tax, and then you calculate your AMT. You only end up paying the AMT if it's higher than your regular tax. For our taxpayer Courtney, even after adding back her state and local taxes, her regular tax was actually still higher than her calculated AMT. Because of that, her AMT liability drops to exactly 0. The system worked perfectly as intended here. She was already paying enough. All right, Section 3, FICA and self-employment taxes. Let's explore the hidden costs of your daily grind or side hustle, because this is a massive part of the tax code that completely blindsides people starting their own businesses. And here we have the classic side hustle dilemma. FICA taxes fund Social Security and Medicare, right? Well, as an employee at her architecture firm, Courtney only pays half of that burden, 7.65%, while her employer steps up and matches the other half. But for her weekend consulting gigs, where she's acting as an independent contractor, there's no employer to help out. She has to bear the full 15.3% weight of those taxes entirely on her own. Now, Courtney's architecture firm actually offered to hire her back as a contractor if she ever left her day job. But before jumping into full-time consulting, she's got to weigh these IRS classification factors. Being a contractor isn't just a fancy title. The IRS looks closely at who controls the work, who sets the hours, and who carries the financial risk. She really has to balance the freedom of setting her own hours against the very real loss of employer-provided fringe benefits, and of course, losing that sweet employer FICA match. Now, there's a very specific multiplier you need to know about. Because self-employed taxpayers are hit with both halves of the FICA tax, the IRS throws them a tiny bone. They get an implicit deduction by multiplying their net business income by 92.35% to find their actual tax base. It basically mimics the employer-side deduction, softening the blow just a little bit before that heavy 15.3% tax rate is applied. Let's head into Section 4, Power of Tax Credits. We've reached the absolute best, most rewarding part of the tax formula. If you've been gritting your teeth watching the taxes add up, this is where we finally start chipping away at that bill. So let's tackle a question that trips up almost every taxpayer when they're trying to reduce their final bill. What's better, a tax deduction or a tax credit? You hear both terms thrown around constantly during tax season, but which one do you actually want more? The massive, absolute game changer here is the dollar-for-dollar distinction. A deduction just lowers the income you're taxed on. So if you're in the 24% bracket, a $100 deduction only saves you $24. But a credit directly wipes away your tax debt. A $100 credit saves you exactly $100. This makes credits a vastly more powerful tool for your wallet than a standard deduction. To put that into perspective, take the Child Tax Credit. It provides up to $2,000 per qualifying child under 17. Because this is a true credit, not a deduction, it offers a massive dollar-for-dollar reduction for parents like Courtney. With one child under 17, she literally wipes $2,000 straight off her gross tax liability. Boom, gone. But to truly maximize these credits, you have to follow an exact sequence. You see, non-refundable credits can only bring your tax bill down to zero. Anything extra is just lost forever. Refundable credits, on the other hand, can actually trigger a check from the government if they push your bill below zero. By following this specific sequence, you make sure you apply the use it or lose it non-refundable credits first. That way, you don't lose the precious cash value of your refundable ones. Finally, we arrive at Section 5, Prepayments and Penalties. This is the last phase of the formula where we settle the tab with the government. You've calculated what you owe, you've subtracted your credits, and now it's time to see what you've already paid. Because the U.S. uses a pay-as-you-go system, you aren't actually supposed to wait until April to pay your taxes. Your ultimate refund or your final painful bill depends entirely on what you've already paid in throughout the year. That happens either through W-2 withholdings extracted directly from your paycheck by your employer, or through those estimated quarterly payments you have to make yourself if you're self-employed. Now, if you fall behind on those prepayments throughout the year, like Courtney unfortunately did with her consulting income, you can get hit with some pretty annoying underpayment penalties. The only way to avoid these frustrating fines is if your prepayments hit one of two specific safe harbor percentages. Basically, you must have prepaid either 90% of what you owe for the current year or 100% of what you owed the previous year. So we've built your tax formula from top to bottom today. We've seen how regular tax rates, alternative minimums, self-employment burdens, and tax credits all completely collide to create your final number. I'm going to leave you with this final thought as you look toward your next tax filing. Now that you know the exact formula, are you going to just react to what the forms tell you, or are you going to use this structure to start actively managing your tax destiny? Thanks for joining me on this explainer, and I'll catch you next time.